Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to the show. Josh, here's the number I want people to sit with. Wells Fargo has about $36.2 billion of direct exposure to private credit firms, not to households, not to plain vanilla C&I borrowers, to private credit firms. And the scary part isn't necessarily the first charge-off. It's the decision that can come after that.
The $36.2 billion is the thing that jumps out, because that's not a rounding error. That's not watch list, maybe someday. That's big enough where even modest deterioration starts leaning on earnings. And when earnings get leaned on, management starts doing what managers always do: defending liquidity, defending optics, defending the dividend if they can.
Exactly. People hear private credit exposure and they imagine one bad loan. That's too simple. The deeper issue is interaction. You've got credit stress on one side, and on the other side, a held-to-maturity securities book that still carries rate shock losses from 2022 and 2023. Those bond losses don't disappear just because accounting lets you avert your eyes.
The phrase held to maturity sounds comforting, like grandma put the bonds in a safe and threw away the key. But the key is still there. If liquidity gets tight, somebody can walk over to the safe, open it, and discover the bonds are worth less than the carrying value. That's when the accounting bedtime story ends. Usually at 2 a.m., usually with very bad coffee.
That's right. If private credit losses remain manageable, fine. A bank absorbs them through provisions, earnings get bruised, life goes on. But if those losses contribute to funding pressure, say deposit competition intensifies, wholesale funding costs rise, counterparties get twitchy, then management may have to choose between preserving liquidity and preserving the accounting treatment of the securities book.
Let me say that back in plain English. The first hit might be a private credit problem on the income statement, but the bigger hit could come later if that pushes the bank into selling bonds it was pretending, legally, it would never need to sell. That second hit is where paper pain becomes cash pain.
Almost, not pretending, at least not necessarily. Under the rules, if management intends to hold those securities to maturity and isn't more likely than not required to sell, then unrealized losses stay out of current earnings. But that condition is fragile. A change in circumstances can collapse it very quickly.
And that's what investors miss. They look at a giant bank and think scale equals safety. Sometimes scale just means the plumbing is more complicated. If you've got one pipe labeled private credit and another labeled HTM, people analyze them separately. In a stress event, those pipes meet behind the wall.
Correct. And in banking, hidden connections matter more than headline labels. The market tends to focus on the visible loan loss. I'm more interested in what management is forced to do because of that loss. That's where crises usually begin, not with the first bad asset, but with the second-order decision made under pressure.
Which is a very fatherly way of saying the first crack in the windshield isn't the crash. It's when the driver jerks the wheel. That's the tension here. Let's stay with the scale for a second, because the $36.2 billion direct number is already substantial. But that's not the whole picture, right?
No, not even close. Bloomberg's April 2026 reporting put Wall Street Bank's exposure to private credit firms at least $100 billion. Wells Fargo's roughly $36.2 billion is a large chunk of that direct exposure. But then you have the broader regulatory category, loans to non-depository financial institutions, or NDFIs. That bucket is much bigger and much messier.
NDFI is one of those lovely banking acronyms that sounds harmless. So translate that. When we say non-depository financial institutions, who are we talking about?
Entities that do financial intermediation without taking traditional bank deposits. Think business development companies, private credit funds, specialty finance companies, asset managers with lending vehicles, various finance firms that borrow from banks and lend onward. They sit between capital and borrowers. They are middlemen in credit creation.
So not the neighborhood bank, not the consumer with a mortgage, more like a chain of professional lenders lending to other borrowers with bank financing underneath them.
Yes, and that distinction matters. If a bank lends to an operating company directly, you can underwrite that company's cash flows, leverage, industry, collateral. When you lend to an intermediary, you're underwriting a platform, a pool, a strategy, and often marks on underlying assets. You're one layer removed from the real economy, sometimes two.
That one layer removed line is the thing, because a single bad loan is annoying. A web of exposures is different. If the borrower is a fund and the fund owns loans, and those loans are to companies in sectors under pressure, then the bank isn't just exposed to one credit, it's exposed to the financing model.
Precisely. Investors need to stop thinking in terms of isolated defaults. The risk is networked. Business credit intermediaries depend on stable funding, stable collateral values, and confidence in reported marks. If any of those weaken, the bank can find that the problem is broader than this borrower missed a payment.
And banks like Wells show up near the top of those lender lists, which means if stress starts in the private credit ecosystem, the transmission channel to the banking system is not theoretical. It's already wired in.
Right. The word exposure is doing a lot of work here. Direct exposure to private credit firms is one thing. The larger NDFI exposure suggests the bank has committed significant balance sheet capacity to institutions whose business is leveraged credit intermediation. That is not automatically bad, but it is cyclical, and it is opaque enough that by the time the market sees deterioration, the easy exits are gone.
In other words, if you build an ecosystem out of lenders lending to lenders, don't act shocked when the map starts looking like a plate of spaghetti. Tasty in good times, less charming in a panic.
Fair. And once you understand that spaghetti, Wells keeps appearing in the middle of it. That's why this isn't just about one headline number. Wells Fargo keeps showing up because market reporting has singled out its lending to business credit intermediaries as unusually large, near the top among major lenders. That doesn't mean imminent disaster. It means concentration in a part of the market that only looks boring when the cycle is calm.
Near the top is the phrase that sticks. Not present, not participating, near the top. So if you're an investor, you don't need to assume fraud or incompetence. You just need to accept that being a big lender to the middlemen puts you in the blast radius if the middlemen get stressed.
Correct. And then look at the collateral mix that's been discussed: business services, software, and healthcare. Under normal conditions, those sound like reasonable sectors, but they each carry valuation sensitivity. Software obviously is vulnerable to multiple compression and changing growth assumptions. Business services can be cyclical. Healthcare has its own reimbursement and policy risks. And now layer in AI disruption, especially in parts of software and service-heavy models.
The software piece is important. If collateral is tied to enterprise software businesses that were underwritten at rich multiples, then a valuation reset matters even if the company is still alive and still paying. A lender can be right on default and still wrong on recovery.
Exactly. Credit investors often comfort themselves with structure covenants, over collateralization, margining features, borrowing bases. Those are real protections. I don't dismiss them, but they are not magic. When several weak links are stressed at once, those protections can erode together.
Let me grab margining features because that's one of those terms people hear and assume solved problem. Margining just means if the collateral value falls, the borrower may have to post more collateral or reduce borrowings. Fine. But if collateral values are falling across the board and financing is tighter everywhere, posting more collateral is like asking a dehydrated man for more water.
That's a good analogy. The mechanism works best in idiosyncratic stress. One borrower has trouble, the system absorbs it. It works less well in correlated stress. If business services, software, and healthcare valuations all soften together, not collapse, just soften, then lenders throughout the chain start making the same calls at the same time.
And correlated stress is the investor phrase for everybody discovers they own cousins of the same problem. Different last names, same family reunion.
Indeed. Also, these are not exchange traded assets with instant price discovery. Valuations can lag, marks can be smooth. Reported stability can create the illusion of safety right up until refinancing or cash flow pressure forces more honest prices.
So the nuance is yes, the portfolio may have cushions. Yes, there may be borrowing based protection. Yes, senior positioning matters. But if multiple sectors are repriced, those cushions are thinner than they looked in PowerPoint.
And Wells, because of its size in this lane, becomes a useful case study, not because it's uniquely reckless, but because it illustrates what happens when a large bank is deeply connected to private credit intermediaries. At the same time, it still carries underwater securities in the background.
This is where I think people get seduced by the recent history of private credit. It stepped into a vacuum, banks pulled back, regulation got heavier, and private lenders said, fine, we'll do it. For years, that looked smart, disciplined, almost elegant.
It did, because in a rising market, many sins are concealed. Private credit grew by lending where banks were less willing or less able to lend. Again, that's not inherently bad, but as an asset class grows, underwriting often drifts, competition rises, structure weakens at the margin, borrower quality inches down, leverage accumulates in places people stop examining closely.
Inches down is the right phrase. Bad cycles rarely start with everybody going insane at once. It's more like one committee approves something slightly weaker, then another does, and 3 years later, everybody swears they're still disciplined. The financial equivalent of eating one cookie every night and then blaming the scale.
Yes. The issue here is ecosystem dependence. Private credit relies on stable financing, stable marks, and confidence. Stable financing means the lenders to the funds remain available. Stable marks mean asset values don't get questioned aggressively. Confidence means investors, counterparties, and borrowers all keep believing the structure works.
Take away one leg and maybe it wobbles. Take away two and now the whole stool is doing acrobatics. So if a fund sees redemption pressure, or its portfolio companies need refinancing at worse terms, or valuations come down, the stress doesn't stay politely inside that one vehicle.
Correct. The spillover matters. Banks may not own all the risky loans directly, but they may finance the entities that do. So when one part of the chain weakens, say lower valuations or refinancing stress, the bank can wind up funding the adjustment. More collateral demands, more monitoring, maybe tighter terms, maybe less willingness to roll financing. That feeds back into the borrowers.
And because private credit is less transparent than public markets, the timing gets awkward. Public bonds reprice immediately, brutally, sometimes excessively. Private assets can stay marked smoother for longer. That smoothness gets sold as stability. Sometimes it's just delayed embarrassment.
Precisely. Marks that move slowly are not the same as values that are stable. In a credit cycle, refinancing is the truth serum. If a borrower can't refinance except at a much higher rate, or can only refinance with more equity support, then prior marks were probably optimistic.
Truth serum is a good way to put it. Cash flow doesn't care what your model said 6 months ago. And if banks are financing these intermediaries, they're not just exposed to credit risk, they're exposed to confidence risk. Once counterparties start asking harder questions, funding itself gets more expensive.
And that is the bridge to the accounting issue. Because as long as financing remains available and confidence remains intact, the HTM losses stay dormant. But if private credit stress contributes to liquidity pressure, dormant becomes relevant very quickly. Let's do held to maturity accounting plainly. Under ASC 320, if management intends to hold certain debt securities to maturity and is not more likely than not required to sell them before maturity, those securities are carried at amortized cost rather than current market value. So if rates jumped in 2022 and 2023 and the bonds fell in market price, that unrealized loss doesn't fully run through current earnings the way fair value treatment would.
The phrase amortized cost sounds technical, but the everyday translation is we're carrying the bond based on what we expect to get if we just keep sitting on it, not what the market would pay us today.
That's right. If I own a treasury or mortgage-backed security yielding, say, 1.5%, and rates move to 4.5 or 5%, the market value of my old low coupon bond falls. Economically, I've taken a loss if I need to sell it today. But under HTM accounting, if I can hold it to maturity, I eventually get par back. So the loss remains unrealized for accounting purposes.
And that's where the financial Schrodinger's cat idea comes in. The loss is both real and unreal at the same time. Real because the market would absolutely pay less today. Unreal because accounting says, well, maybe you never have to care.
Exactly. It is a very useful mental model. The loss exists economically, but the accounting shield stays in place as long as the bank can credibly say it intends and is able to hold. The moment a sale becomes necessary, the box opens and the cat is no longer theoretical.
Which is why I always get nervous when people say, those HTM losses don't matter. No, they may not matter today. That's different. A buried gas line doesn't matter either until somebody starts digging.
Exactly. And investors should be careful here. HTM treatment is not a fraud. It reflects a legitimate distinction between trading assets and long duration securities intended to be held. But in stress analysis, what matters is conditionality. If there is any realistic path that could force liquidity generation, those unrealized losses belong in your mental model.
Let me try the 1-foot explanation. A bank owns bonds that got smoked when rates rose. If the bank can keep them until they mature, accounting lets management avoid taking the loss through earnings right now. But that only works if nobody forces their hand. If they need cash, the accounting cloak comes off.
That's basically correct. And Wells is important in this discussion because the concern is not merely that it has HTM losses. Many banks do. The concern is the combination: sizable private credit and NDFI exposure on one side, and a still sensitive securities book on the other. Stress one side hard enough, and the other side stops being dormant.
So the vault is quiet until management needs a crowbar. Then we find out whether held to maturity was a strategy or just a hope with a spreadsheet attached. Okay, so what actually trips the wire? Because people hear forced sale and think there's some dramatic regulator in a trench coat kicking the door in. Usually it's more mundane than that.
Much more mundane. The critical tripwires are intent to sell and more likely than not required to sell. If liquidity pressure or capital pressure becomes strong enough that management must sell HTM securities to raise cash, the unrealized losses on those securities stop being abstract. They become realized losses.
Grab more likely than not required to sell, because that phrase does a lot of damage in only 7 words. It means you don't even need an actual sale first, right? The condition itself matters.
Correct. The accounting framework hinges on management's ability to assert that the securities can remain untouched until maturity. If circumstances undermine that assertion, the shelter weakens. And if the bank actually sells HTM securities, there is also tainting risk, meaning it becomes harder to maintain HTM treatment for the rest of the portfolio because the sale calls the original intent into question.
Tainting risk is one of those phrases that sounds like Victorian moral panic, but it matters. Sell one piece for liquidity, and now the market starts asking whether the rest of the "we'll never sell this" book is really a "we'll never sell this unless Tuesday gets weird" book.
Yes, and Tuesday often does get weird in banking. The real danger is the feedback loop. Start with private credit losses. Those hit earnings via provisions or charge-offs. Then funding costs can rise. Deposits become more expensive to retain. Wholesale markets demand more spread. Counterparties become cautious. Management responds by protecting liquidity. If that means selling securities, the bank realizes losses it had hoped to avoid.
So stage 1 is credit pain, stage 2 is funding pain, stage 3 is accounting pain becoming capital pain. And each stage makes the next one more likely.
Exactly. This is why I dislike simplistic commentary about paper losses. Paper losses are only harmless in a world where the institution never needs liquidity under stress. That world does not exist. Banks are confidence machines. Once confidence is questioned, liquidity becomes precious, and assets that were theoretically long-term suddenly become immediate sources of cash.
And the cruel part is, management might do the rational thing in the moment. If funding is tightening, raising cash is prudent. But prudent actions can still crystallize bad economics. You save the plumbing by breaking the vase.
That is well said. The issue is not villainy, it is path dependence. Once the bank is on that path, choices narrow. And markets know this. They begin to price not what the bank says today, but what it may be compelled to do tomorrow.
Which is why investors should pay less attention to reassuring language and more attention to tripwires. If provisions rise, if funding costs rise, if deposit behavior changes, if liquidity buffers get used, those are the tells, not the glossy slide saying everything is diversified.
Let's lay out the stress chain cleanly. Stage 1, private credit losses emerge. That could mean several $1 billion of charge-offs or provisions in a tougher scenario. Not apocalypse, just enough to materially pressure earnings. Stage 2, funding stress follows. Think tens of billions in modeled outflows, more expensive deposits, tougher wholesale terms. Stage 3, management sells a slice of HTM securities to defend liquidity, and meaningful realized losses appear.
Several billion and tens of billions are the numbers people need to hold on to, because that's the scale where the conversation stops being academic. If you've got several billion in credit pain and then tens of billions in outflow pressure, even selling a modest slice of the HTM book can sting if those securities are still below par.
Right. You do not need the entire HTM portfolio to be dumped into the market. That's a cartoon scenario. If just a portion must be sold, and that portion still embeds rate shock losses, the realized hit can be meaningful. And once realized losses show up, market psychology changes. Analysts stop treating the securities book as background noise.
That's the part I've seen in other contexts. The first loss gets explained away. The second loss gets modeled. By the third loss, everybody suddenly discovers religion and starts talking about risk discipline. Amazing how pious Wall Street becomes after the horse is gone.
Indeed. The broader takeaway is not Wells is doomed. That's not the point. The real question for investors is structural. If one major bank can carry hidden rate risk in HTM while also having meaningful exposure to private credit intermediaries, how much of the sector has the same architecture?
And architecture is the right word. We're not talking about one cracked tile. We're asking how many buildings were designed with the same basement. Because if this setup exists across the sector, then the market may still be understating the combination risk. Credit stress on top, duration stress underneath.
Yes, investors should examine banks not just for credit quality in isolation, and not just for securities marks in isolation, but for the linkage between the two. Which institutions are financing the private credit ecosystem aggressively? Which institutions still carry sizable underwater HTM books? And which rely most on stable confidence to keep those two worlds from colliding?
That's the lingering question, isn't it? Not whether a bank can survive one bad quarter. Most can. It's whether the system has quietly stacked one kind of hidden leverage on top of another and called it diversification.
Exactly. In banking, what is hidden is often more important than what is disclosed. And what is disclosed is often more fragile than it appears.
All right, on that cheerful note, go read the footnotes, not the slogans. Thanks for listening.
We'll see you next time.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.